I have a copy here I've had for many years of your best-selling book, Tax-Free Wealth. This is sort of a Bible for, I think, any individual that is looking to get smart on strategies to start talking with your accountant about. And in here, you talk a lot about understanding the difference between taxable income and cash flow. Can you just help the audience understand that a little bit better?
Yeah. So
that they are not equal.
So perfect example. We have Donald Trump's tax returns to look at. Whether we like it or not, we do. And I've gone, wow, this is an unique opportunity to look at somebody who's clearly done extremely well in business and look at what does the tax return look like? Well, the tax return shows huge losses. Okay. But there is no way Donald Trump could be jetting around the world and doing what he does if he has no cash flow. So the tax return reports, this is what we learned from Donald Trump's tax returns, that he paid no tax. We don't learn what his cash flow is because the tax returns don't tell us anything about his cash flow. All they tell us is what he had to, the way it was reported to the government, because the government has different rules for reporting your income than the accounting rules. And so that's a perfect example. Cash flow and taxable income are very, very different.
Okay. And I'm going to use an example. You tell me if there's a better one that's out there, but to help understand the difference between what's taxable versus the actual cash flow that you receive. So, I might buy a car, right? And through my business, and that allows me to deduct an type of expense called depreciation on that car. And from a tax standpoint, basically I drive the car for a year and the tax code says you're allowed to depreciate a certain amount of that value of that car every year. So any given year, I take some percentage of that car and I report it as an expense, right? Because the car depreciated in theory by that percentage value. So it looks like money was going out the door as an expense. It's reducing my taxable income, but I didn't spend any money. That depreciation by itself didn't take dollars out of my bank account. Sure, the gas I paid for the car did, or any repairs I did, but the depreciation itself really wasn't. It's more sort of a phantom loss, if you will, on the balance sheet. So that's just one way in which my cash flow from the depreciation was zero. I didn't have any cash going out the door, but I might have reported several $1,000s in depreciation for my income tax statement because of what the tax code allows me to do. Yeah. That's just one way in which I think of it.
No, you're absolutely right. And what's better is while a car may be going down in value, and so you're going, okay, depreciation is recovering the cost of that car going down in value. Think about real estate. You get depreciation on real estate and it can be going up in value. It doesn't have to be going down in value in order to get that deduction. You simply have to be using it. For example, let's say you bought a vintage Ferrari. You've got that car. It may be going up in value, but at the same time, if you're using it in your business, you've got a business purpose for using it, you could be getting a deduction. So again, it's an asset that might be producing cash flow, but at the same time, you're getting a tax deduction for it.
How do you go about using your expertise to help clients save wealth through tax planning? Is there a framework you use or a process you use? Is there a starting point when you're starting with a new client?
There's a formula to it. I mean, it's a pretty simple. You do this, then you do this, you do this, you do this. You don't have to say, well, you have to be as smart as Warren Buffett to do it. No, you just have to follow the rules and follow the system, and you're going to produce that income. You're going to produce that wealth. The same is true on the tax side. If you look at the tax law, there are patterns in the tax law, just like there are weather patterns, right? The reason we can predict a hurricane is because of the weather patterns and the history. And so we know, okay, well, this is likely to hit at this point. Here's where it's going to go. Yeah, we might be off by a few hundred miles, but we're going to be close, right? The same is true with the tax law. We can predict what will happen when we invest a certain way. We can predict what will happen. And so what we do with our clients, and I know we're fairly unusual in this, but we actually start with the tax planning and then follow with the tax compliance. So compliance is not something that's real valuable to most people. It's something that you have to do. But tax planning, we can reduce your taxes. Well, that gets pretty exciting. So we start with the planning. In fact, we actually require it. We won't even take on a client unless we start with the planning.
Where do you typically find the biggest bang for the buck when you help somebody go from however many taxes they're paying today to hopefully paying less?
The biggest bang for your buck is always going to be a business. Okay. And it doesn't matter what country you're in. The biggest bang for your buck is going to be business. So my new book, The Win-Win Wealth Strategy, talks about those different areas of investing and how those different areas reduce your taxes. But business is the big one. And then when you're talking about business, you're talking about, okay, how do I own my assets? We refer to that as what entities do you use, like a corporation, a partnership, a limited liability company, whatever you're going to use. But that's actually the number one thing people can do is figure out the best way to own their assets. We always say you own nothing, control everything. You don't want to own the assets of the business. You want the business to own the assets of the business, and you own the business. So it's that type of thing. You don't want to own the real estate itself. You want to own a company that owns the real estate. So how you do that has such a big impact on your taxes. It's kind of rule number one is how you set up your business. Rule number two is remember that anything can be deductible. So the question is not, is something deductible? The question is, how do I make it deductible? And we like to say that if you want to change your tax, you have to change your facts.
Okay, fascinating. Okay, so first off, I'm assuming businesses or incorporating really helps because that's a vehicle by which to have business deductions, right? Business expenses. And when you said own nothing, control everything, totally makes sense. You want the most tax advantaged entity to own the assets. I presume there's also, in many cases, like liability shielding benefits that come along with that too, right?
There's really four aspects of the planning that we're doing. You're very involved in the wealth side. You really do need a wealth strategy. You've got to have a tax strategy, but you do need an asset protection strategy because you're building wealth. Remember that people are coming after that wealth.
Right.
And so we do want to set things up so that they're protected from lawsuits, et cetera. And then, of course, most people who are building wealth want to leave a legacy. And so that's the fourth aspect that you really want to look at. So when we look at a client, we're actually looking at a very holistic viewpoint and all four of those.